So Instacart, Adam, another one that's had, massive valuation cuts. I believe it was, valued at $39 billion at the height of its popularity in the middle of the pandemic. Now we're down to $13 billion. What's your expectation with this one?
I think, Instacart's in an interesting position because they don't really need the money right now. They've done a few things that are very, very astute. One, they raised capital at a higher valuation. Secondarily, they got their business model such that they became cash flow positive. And number three is they've evolved their business model so that they have alternative sources for it. So they have an advertising model, which is doing extremely well. All that adds up to they don't need to do a offering right now. The reason for doing an offering would just be to get some liquidity to a 10-year-old company for some of their employees. But I don't think they need to force to do it. I think there's another dynamic, though, that's out there, Emily, that's as interesting. And this is this legislation that's floating around Washington right now, which is the reclassification of gig workers. That's something that would have a material impact on their cost structure for these shoppers going from being independent contractors to being treated as employees. That I think the company is certainly up for it. It's a very well-managed company. Fiji is doing a great job. And so did Apuva, and this is a company that went from 200,000 shoppers to 500,000 shoppers during the height of the pandemic. This is a well-managed business, but all that's being said is that there's no need right now for them to have to do an IPO in a very, very auspicious market environment.
So are you saying that you think if they have to classify these workers as employees, it's not going to dramatically negatively impact the company, that they're prepared for it?
What I'm saying is that I think that they would be able to handle it because it's going to certainly impact the valuation models that institutions are looking at, for sure. And I think that in and of itself is a reason you hold off on rushing into an IPO market when you don't need to do it. This is a consumer-facing business. The aura of an IPO is important, and there's no reason to rush into a market. When you're in an environment like we're in right now, where there's so much red on the screens of institutional investors from past IPOs, you really need to pull off a transaction successfully. What you really need to do is you have to have everything aligned. So you don't need this other variable right now out there, which is impacting their cost structure. So I guess what I'm saying is they don't need to do it right now. I think they're up for the task if that's where the legislation happens. But that's far from a fait accompli right now.
Well, just talked to Crystal about the era of the unprofitable IPO, which was hugely popular, especially among technology companies. Instacart saying it's turned the corner on profitability. So I imagine that might be one less thing for investors to worry about. Is the era for unprofitable IPOs, is that over?
I think I wouldn't say you never say never, so I wouldn't say it's over forever, but I'd definitely say it's over for the short term. I'd say that, there's a focus, and we're seeing this in our business across the board. We do a lot of M&A transactions. We're doing a lot of capital raising. We just raised $500 million for a business. There's a big focus on more mature models that have provided a pathway to profitability or demonstrating that their models are evolved. The days of companies going out with a somewhat of a pipe dream into the public markets, which frankly they shouldn't have been in the public markets to begin with. I think that, at least for the near term, we're not going to see that for a while.
So how are you changing your strategy, and what are you telling your clients amidst these evolving conditions?
Well, I think what we're telling people is, one, the M&A market continues to be open, particularly from very, very good areas. Things like cybersecurity, ESG. We do a lot of work with digital analytic businesses and digital transformation companies. These are companies that have core organic growth within their addressable markets, which are going to continue. What we are telling people is that for those who are considering the IPO market right now in this environment, that is not something that we would strongly recommend, for sure. It's definitely not something that needs to be done. I think that there are, in between all this negative discussion, is that still this year we're going to have a record amount of capital coming into venture funds. It's just going to be more concentrated. And I just think there's a flight, it's just a general flight to quality. So that's what we're advising people, that don't rush ahead to do something unnecessarily, but there's certainly a market and there's certainly transactions to be done. And the transactions to be done at very, very fair valuations for companies that have more mature business models and have the economics to support it.
How long do you think the downturn will last? We're hearing, 6 months for the IPO window to reopen. I'm hearing from some other more skeptical folks, 2 to 3 years before we're out of this.
Yeah, it's a great question. When you look at what has happened over a period of time, right now, all these valuation models that institutional buyers look at are predicated on an interest rate. When you don't know what that interest rate is going to be, it's very, very hard to build the models accordingly. So it becomes very, very challenging when you have a Fed that is focused on breaking the back of inflation. And that's certainly the right thing for them to be doing, but it's hard to do that. I think that once you get to a stalled period of time in interest rate raises, and you start to see that we're entering into, and you start seeing the labor statistics supporting that, I think you're going to see a market that's going to be more receptive. And when markets start opening to the IPO market, the companies that go out in those environments have to be primo. They have to be the best companies in their environment. And that's really what's traditionally happens in any sort of bad IPO market. The market comes back because the best of the best go out there. They work. The institutions start feeling a little bit more comfortable, and then you start seeing additional companies come out. I would say, to answer your question, I'm thinking mid-time next year. I would say, Q4, no. Q1 still feels a little early. I would say maybe Q2, Q3, you start seeing it. And again, the equity capital markets are an environment that's, front runner. So we're going to be out in front of the economy.